6. Decoding cost structure and operating leverage. What cost of revenue actually covers? Every dollar of revenue a company earns requires some cost to produce or deliver it, and that cost is recorded as cost of revenue, also called cost of goods sold. The composition of cost of revenue differs significantly depending on the business model. For a manufacturer, it typically includes raw materials, factory labor, and production overhead such as equipment depreciation and facility costs. For a retailer, it is almost entirely the wholesale price paid to purchase goods for resale. For a software or cloud business, it includes data center costs, server infrastructure, royalties, and the personnel who maintain and support those systems. Microsoft cost of revenue. Microsoft separates its cost of revenue into two lines on the face of its income statement. Cost of product revenue covers manufacturing and distribution for hardware, such as Surface devices and Xbox consoles, as well as costs related to on-premises software. Cost of service and other revenue covers data center operations, technical support, traffic acquisition, and consulting delivery costs. In fiscal year 2025, Microsoft reported total cost of revenue of $88 billion against total revenue of $282 billion. Product cost of revenue was $14 billion on product revenue of $64 billion, producing a product gross margin of approximately 79%. Service cost of revenue was $74 billion on service revenue of $218 billion, producing a service gross margin of approximately 66%. The difference between those two margins reflects the higher infrastructure cost of running large-scale cloud operations compared to software licensing. Part 2. What operating expenses consist of. Below gross profit, companies report operating expenses, which cover the costs of running the business that are not directly tied to producing the product or delivering the service. These typically fall into three categories: research and development, sales and marketing, and general and administrative expenses. Research and development covers the payroll, benefits, and third-party costs of building future products and technologies. Sales and marketing covers the salaries of the sales force, advertising, promotions, trade events, and channel partner programs. General and administrative covers corporate functions such as finance, legal, human resources, and executive leadership. Microsoft operating expenses. Microsoft reported total operating expenses of $65 billion in fiscal year 2025, broken down across three lines. Research and development was $32 billion, representing approximately 11% of total revenue. Sales and marketing was $26 billion, representing approximately 9% of total revenue. General and administrative was $7 billion, representing approximately 3% of total revenue. The dominance of research and development in Microsoft's cost structure reflects a strategic choice to invest heavily in AI, cloud infrastructure, and product development to sustain long-term competitive position. Analysts compare each of these line items as a percentage of revenue across multiple years to detect whether the company is gaining or losing efficiency as it grows. If revenue grows by 15%, but research and development spending grows by 25%, the company is investing. Part 3. Fixed versus variable costs. Every cost a company incurs can be classified based on how it behaves when revenue changes. Variable costs move in proportion to revenue or output volume. Raw materials, sales commissions, and cloud hosting costs that scale with usage are typical variable costs. Fixed costs remain constant regardless of how much the company produces or sells. Rent, salaried headcount, and depreciation on owned equipment are classic fixed costs. In practice, many costs are mixed, meaning they have a fixed base component and a variable component on top. For example, a sales team has fixed base salaries but variable bonuses tied to deals closed. Operating leverage defined. Operating leverage describes how much of a company's total cost structure is fixed rather than variable. The higher the proportion of fixed costs, the more sensitive operating income is to changes in revenue. When revenue rises, fixed costs stay flat, so each additional dollar of revenue flows to operating income at a higher rate. When revenue falls, fixed costs do not compress, so operating income deteriorates faster than revenue declines. This formula measures how many percentage points of operating income change result from each 1 percentage point change in revenue. A company with a degree of operating leverage of 3 would see operating income rise by 30% if revenue rises by 10%, and fall by 30% if revenue falls by 10%. This leverage effect is not a risk to avoid, but a structural characteristic to understand before making valuation assumptions. Part 4. Microsoft and operating leverage. Microsoft's cost structure is heavily weighted toward fixed costs, which gives it high operating leverage. Research and development spending, depreciation on data centers, and salaried engineering headcount do not shrink meaningfully when revenue softens in a quarter. In fiscal year 2023, Microsoft reported revenue of $212 billion and operating income of $89 billion, an operating margin of 42%. By fiscal year 2025, revenue had grown to $282 billion and operating income had grown to $129 billion, an operating margin of 46%. Revenue grew by approximately 33% over that two-year period, while operating income grew by approximately 45%. Operating income grew faster than revenue because the fixed cost base absorbed additional revenue with very little additional cost. That is operating leverage working in the company's favor during a growth cycle. Impact on valuation. Operating leverage directly affects how analysts build valuation models and assign multiples. A company with high operating leverage and growing revenue deserves a higher valuation multiple because incremental revenue converts to profit at a rising rate. Conversely, if a high operating leverage business faces a revenue slowdown, the downside to earnings is steeper, which introduces risk that analysts reflect in lower multiples or higher discount rates. When building a financial model, analysts must map which costs are fixed and which are variable before projecting future margins. Applying a flat margin assumption without understanding cost structure will produce inaccurate profit forecasts under any revenue scenario.